The Tax Cuts and Jobs Act of 2017 created an opportunity for investors to minimize taxes on capital gains while improving low-income areas. Opportunity zones are aimed at creating jobs and providing incentives to develop economically distressed communities that are certified by the Internal Revenue Service. Today, we will check out what are opportunity zones. Before starting the video, please subscribe to our channel so you can also click on the bell icon and get notified when we upload the next video. Number 10. What is an opportunity zone? An opportunity zone is a community nominated by the state and certified by the Treasury Department as qualifying for this program. The Treasury Department has certified zones in all 50 states, Washington, D.C., and U.S. territories. There are approximately 8,700 opportunity zones nationwide. A list can be found at the U.S. Department of Housing and Urban Development. Opportunity zones are economically distressed communities designated by states and territories and certified by the U.S. Treasury Department, in which certain types of investments may be eligible for preferential tax treatment. The tax incentive is designed to spur economic development and job creation in distressed communities by providing these tax benefits to investors. Effective June 14, 2018, Treasury certified opportunity zones of all states, territories, and the District of Columbia. Opportunity zone designations certified by Treasury will remain in effect until December 31, 2028. Number 9. How does this program work? To defer a capital gain, a taxpayer has 180 days from the date of the sale or exchange of appreciated property to invest the realized capital gain dollars into a qualified opportunity fund. The fund then invests in qualified opportunity zone property. The taxpayer may invest the return of principal as well as the recognized capital gain, but only the portion of the investment attributable to the capital gain will be eligible for the exemption from tax on further appreciation of the opportunity zone investment, as explained below. The Opportunity Zone program allows for the sale of any appreciated assets, such as stocks, with a reinvestment of the gain into a qualified opportunity fund. There is no requirement to invest in a like-kind property to defer the gain. Note that a taxpayer who receives a reported capital gain from a flow-through entity, such as a partnership, an S-corporation, or a trust estate, has 180 days from the end of the calendar year to make an investment in a qualified opportunity fund, regardless of how early in the calendar year the entity itself realized its gain. For example, if a partnership entity realized a capital gain in March, each partner's 180-day triggering date will be December 31st of the same year, and each partner will have until approximately June 28 of the following year to make their qualified opportunity zone investment. Number 8. Economic benefits. Opportunity zones generate economic growth with long-term investments in distressed areas, including low-income urban areas, rural communities, and attractive neighborhoods adjacent to distressed areas. Over 15% of the U.S. population lives in a distressed area, allowing QOZ investors to help with job creation and small, community-based businesses. Investments in opportunity zones and QOFs include assets such as infrastructure, industrial projects, workforce, and multifamily housing. Number 7. Tax benefit. Profits from the sale of an asset that are invested in a qualified opportunity fund, QOF, within 180 days from the transaction date have capital gains taxes fully deferred through December 31, 2026. Capital gains taxes owed and reduced by 10% if the QOF investment is held for at least 5 years up to and including year-end 2026. Gains from investments held in a QOF for at least 10 years are excluded from the capital gains tax. The tax benefits of investing in opportunity zones. January 2018, the Opportunity Zones program offers 3 benefits for investing in low-income communities through a qualified opportunity fund. Number 1. A temporary deferral of inclusion in taxable income for capital gains reinvested in an opportunity fund. The deferred gain must be recognized on the earlier of the date on which the opportunity zone investment is disposed of or December 31, 2026. Number 2. A step up in basis for capital gains reinvested in an opportunity fund. The basis is increased by 10% if the investment in the opportunity fund is held by the taxpayer for at least 5 years, and by an additional 5% if held for at least 7 years, thereby excluding up to 15% of the original gain from taxation. Number 3. A permanent exclusion from taxable income of capital gains from the sale or exchange of an investment in an opportunity fund if the investment is held for at least 10 years. This exclusion only applies to gains accrued after an investment in an opportunity fund. Number 6. Who is investing in opportunity zones? Although deferring capital gains tax isn't a requirement for investing in opportunity zones, it's one of the top advantages of opportunity zone investments. Investors with a long-term investment horizon who have gains from any asset including stocks and bonds, precious metals, cryptocurrencies, artwork, and real estate receive benefits right away and over the next several years from opportunity zones. Deferred capital gains taxes due are reduced by 10% and are not payable until the 2027 tax year. Additional capital gains from opportunity zones investments are tax-free, provided they remain held for at least 10 years. Qualified opportunity funds may offer risk-adjusted returns due to preferential tax treatment and incentives, along with the potential for asset growth over the holding period. They're an attractive alternative for 1031 exchange real estate investors because they provide a full 180 days to identify and invest in income properties for sale, compared to the 45-day identification period rule of a traditional tax-deferred exchange. Only the capital gain portion from a sale needs to be invested in opportunity zones versus all of the net proceeds when conducting a 1031 exchange. Number 5. How to invest in opportunity zones. The White House Opportunity and Revitalization Council recently presented the Opportunity Zone Best Practices Report. Some of the best practices for investing in opportunity zones highlighted in the report include local governments are in the best position to understand the unique strengths and needs of their communities. For example, Charleston, South Carolina has created local rules to allow unlimited density and lower parking requirements for affordable housing in opportunity zones. States such as Louisiana adopted legislation providing an up to 10-year abatement of property taxes on renovations and improvements of existing commercial and owner-occupied structures in opportunity zones. Qualified opportunity funds have begun focusing on affordable housing, such as a multifamily mixed-use project in Seattle, which ensures 20% of the nearly 300 apartments are reserved for workforce housing. Number 4. Positive impact of opportunity zone investments. Opportunity zones have received some criticism as another way to make the wealthy wealthier. However, as Forbes reports, opportunity zones could boom in 2021 as nonprofits, economic development organizations, and local and state governments look for ways to make their neighbors better places for residents, businesses, and investors. Affordable housing becomes more feasible due to a lower cost of capital through tax-advantaged QOZ dollars. Investing in existing businesses helps expansion to undeserved parts of the local community. QOFs can be designed to form new companies and scale up existing ones that agree to local their headquarters in opportunity zones, helping create new jobs and higher economic growth. Opportunity Zone investing offers tax incentives, not credits. Those who invest in qualified opportunity funds, known as QOF, can defer taxes on prior capital gains if those gains are invested in a qualifying fund within 180 days. The length of the tax deferral is until December 31, 2026, or when the QOF is sold or exchanged. If the investment is owned more than 5 years, 10% of the gain is excluded from taxes. If it's held longer than 7 years, the exclusion amount jumps to 15%. The greatest benefit goes to investors who hold their QOF investment for at least 10 years. At that point, an investor's capital gains can be eliminated. Number 3. What happens if a business located in an OZ moves? Is there a recapture risk? There is no recapture risk, but an opportunity fund that fails to meet the 90% asset requirement of the fund will be required to pay a penalty for each month it fails to meet the requirement. The penalty is not designed to be catastrophic, but rather to ensure that funds stay within the zone's parameters. Once an asset no longer qualifies, there will be a period of time in which the asset can be disposed of before incurring penalties. Number 2. What qualifies as an Opportunity Zone investment? Opportunity Zone funds must be certified by the U.S. Treasury Department and hold at least 90% of its assets in a QOZ property. To invest in the distressed properties in urban and rural areas, a fund must be organized as a corporation or partnership. Opportunity funds are limited to equity investments in business, real estate, and assets that are located in a qualified opportunity zone. Loans are excluded from the tax incentives. The real estate in the fund must also need extensive rehabilitation. Number 1. Are there investment risks with these funds? Proceed with caution when investing in an opportunity zone fund, experts say. The risk that a bad investment is cloaked inside an opportunity zone investment is something investors must be wary of, as tax savings can be a very sexy sale, says Stephen J. Taddy, a managing partner at Stellar Capital Management in Phoenix. The investments within an opportunity zone must stand on its own. There's a risk that the land and buildings within a zone may already have appreciated, leaving less profit for incoming investors, he adds. While opportunity zone funds are diversified, Clark warns that they are laden with high costs that may offset the tax benefits. Do let us know in the comments, what are your thoughts about opportunity zones? Thanks for watching.